One of the most misleading terms in real estate investing is turnkey, because a deal doesn't become low friction just because the brochure says it is. In this video, I want to walk you through what actually determines whether a multifamily investment becomes hands-off or becomes something you're constantly managing after closing. Because the difference isn't the building, it's the operator stack behind it. If you're new here, I'm Darren from DK Wealth and Growth, and if you've been following along, you know we focus on disciplined CMHC-eligible multifamily investing, not just at acquisition, but through the full life cycle of the deal. And stay with me until the end, because I'm going to break down what hands-off actually requires and why most investors misunderstand it. Most investors hear turnkey and assume the building is new, management is in place, everything runs smoothly. But in reality, the first 90 to 180 days after closing are where the deal proves itself. And during that window, multiple moving parts need to align. If they don't, friction shows up quickly. Here's the reality. A great building can still become a difficult investment if execution breaks down after closing. That's the part most investors never see coming. First is the builder, not just whether the project was completed, but how well it was executed. Are there deficiencies? Are timelines realistic? Was the project delivered with long-term performance in mind? Because anything missed here shows up later. And when it does, it's not theoretical. It becomes real cost, real time, and real management effort. Next is property management. This is one of the biggest variables in whether a deal actually feels hands-off. Are they aligned with the lease-up strategy? Do they understand the tenant profile? Are they proactive or reactive? Because the same building with two different managers can produce very different outcomes. And this is where investors feel the difference. Not in the brochure, but in the day-to-day performance of the asset. Then there's lender and legal coordination. CMHC-eligible deals involve ongoing requirements, reporting, stabilization milestones, performance expectations. If these aren't managed properly, delays and friction can build behind the scenes. So even if everything looks simple up front, the operational complexity doesn't disappear. It just moves into the background. Quick question for you. When you think about a turnkey investment, what does that actually mean to you? Drop it in the comments. I read through them and it helps shape what I break down in future videos. Here's the real definition. A deal becomes hands-off only when the operator stack works. Builder quality, management alignment, lender coordination, execution consistency. When those pieces are in place, the investment feels smooth. When they're not, the investor feels it. So the takeaway is this. Turnkey isn't a feature of the deal. It's the result of execution. And execution doesn't happen automatically. It's built into the structure from the beginning. If this kind of disciplined, real-world approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate deals, not just before they buy, but after the deal becomes real. And if you're evaluating opportunities right now, feel free to drop your questions or topics in the comments. I go through them and I use them to shape what we cover next. If you want to explore opportunities where the operator stack is already structured properly, you'll find links below where you can join the investor list or learn more. Thanks for watching, and I'll see you in the next video.